Welcome to Soundbites, Fidelity's monthly podcast where we talk about all things investments. And today I'm pleased to be joined by a powerhouse of investment brains here at Fidelity. To my left, we've got Paul Taylor. Across from me, we've got James Abela. And also across from me, I have Casey McLean. So thank you, gents, for being here with us. And just for those that aren't familiar with the team, these are the key portfolio managers for our Aussie equity capabilities here at Fidelity. And so this podcast will be a bit of a year in review where we'll reflect on some of the key themes, some of the learnings from the year. And an additional thing we'll have today, because it is the last podcast of the year, and we are having a bit of a nautical theme, and that sort of coincides with our end-of-year Christmas party. And so for the listeners there, we'll be running a competition whereby for the first listener that can email us, and I'll provide the details, with how many nautical references we make during the podcast, we will be giving away a $100 voucher. And the email address is podcastsaustralia@filfil.com. So I'll just repeat that, podcastsaustralia@fil.com. So listen and, get counting. And so we might kick it off. And I think, if we think about this year, it has been a year of ups and downs in terms of markets, but there's been some key central themes, I think, that have really dominated markets this year. And I'd be keen to sort of explore those in terms of some of those themes and how you think they have impacted markets over the year. So maybe I'll start with Paul.
Yeah. Morning, Lucas. Good to be here. Good morning, guys. It's been a really interesting year. I would say it's still been very much a macro year, which I think is interesting. So those macro variables are still very much around interest rates, inflation, and everybody trying to second guess where they're heading. It's still also geopolitical. So we've got two conflicts, one obviously Ukraine, Russia, and then another one in the Middle East. So that's impacting markets as well and some commodities. Just a range of different, I think we've got sort of a range of different, those big picture issues, concerns about recession. Are we going to go into recession? Are we going to avoid it? How's the consumer going? How's the consumer being impacted by interest rates? So a lot of really big macro issues, I think, at the moment as well. And that's really what's driven the market in 2023. I think 2023 is going to finish a bit higher, which is good, which is obviously better than 2022, but still probably the last couple of years have generally been sort of tougher years, and it's fair to say maybe choppy waters.
Mm-hmm. Choppy waters. I like that reference. Maybe
don't tell them when the reference is. You can't actually say this is the reference.
Like it. It's
they've
clever.
got to pick it up themselves.
It's a clever reference. Just with yourself, James and Casey. So obviously, we've had inflation, there are geopolitical risks. Interested if there's any other aspects that you wanted to reference, but also, can you remember a year like this where you've had this culmination of inflation, geopolitical, like a very macro-driven market?
Yeah, exactly, Lucas. I think really it was a year of a lot of mixed signals, and the winds changed direction many times throughout the year. We saw bond yields rallying at one point, declining another. Just in the last few months, right, the S&P 500 in November rallied like 9%, which is the seventh best month in 30 years. And that came after a 9% decline in the 3 months before that as well. So it really has been those choppy waters Paul was talking about, and a pretty directionless sort of market, other than the very narrow breadth I thought that you saw in the US with just the Magnificent Seven outperforming.
James and yourself?
Yeah, definitely. We had choppy waters, and then we had, I think, the soft whitewash trickling onto your feet. And then you had batten down the hatches, and then you had your...
He's going too far. Come on.
Really, open up the sails and go with the blue sky, beautiful flat waters, and let the sails run. So it's been a very choppy year. Very, consumer was very weak. Industrial was very weak during the year. Energy was down and then up again. and it's been very, very, very choppy. And then we've come to the end of it, as Casey mentioned. Small caps are up nearly 10% since the beginning of November. So at the end of November, the market was absolutely flat. And now you've had, the winds come out, sentiment change, and now, market's up nearly 10% in 4.5 weeks. A really big shift in sentiment. You also had a huge amount of risk off. So anything with leverage, anything with beta, all of that did really poorly. And in the last 5 weeks, a lot of that's turned around. So yeah, it has been a very unusual year running, especially small caps for the last 10 years. It's been a very unusual year this year. I mean, the GFC was the only thing similar, but it was very, very different. And it wasn't as choppy. That was down and then up again. This one was up and down all through the year pretty much. So, and leverage was a big one. People talked about, went to conferences during the year. Small cap refinancing fear was pretty much a theme throughout the year. And that I think still holds at the moment, although the markets and sentiments are shifting, that's probably still there.
Yeah, no, absolutely. And I guess one of the interesting things to explore, if you think about last year, and if we sort of cast our minds back to the last several years, like prior to the recent or fairly recent rise in inflation, the market was a fairly benign market, low interest rates, low volatility in markets, all boats rose really over that period. In this environment where we have had that more choppy environment, there's been, intra-sector more volatility and dispersion of outcomes. As portfolio managers, is that a more difficult environment to manage money in, or is it actually an environment where you think there are more opportunities in that type of environment?
Yeah, look, it's probably a little bit of both, right? So volatility provides opportunity. So if individual stocks get hit hard for a reason maybe that's not overly rational and just there's a bit of fear coming in, that often provides you an opportunity to get into stocks that you've wanted to own for a long period of time. But then the ongoing volatility probably doesn't help. I mean, the way I invest, I typically look for things that have got cyclical decline, but then long-term structural growth. So I want to buy into the cheapness of the cyclical decline, and then take advantage of that short term to get long. I tend to go out further out in duration, so I'm looking for those sort of long-term benefits. So once you're going up and down, maybe that doesn't help as much in the short term, but that should still benefit in the long term. I think the other thing, when you get really choppy markets like this, small changes are having big impacts on company valuations, which I think is the other. To me, it also means, when it's so volatile, it also means the market is really not sure how to value companies. They want certainty around a lot of the variables, or at least more certainty. It doesn't have to be perfect certainty, but more certainty. And that helps the market come to grips with what the company's valuation should be. So the volatility also says to me the market really doesn't know what the true value of the companies are when there's so much volatility.
And what about yourselves, gents, from your perspective? Is this type of environment, do you like this type of environment, or is it a sort of environment where you go, okay, well, let's sort of step back a little bit, let the waters calm?
Yeah, generally I think volatility does offer opportunities. And I think if you look across the sort of Australian market, the earnings fundamentals haven't changed massively. Like earnings for the ASX 200 are only down 6% from the peak. What's really swung around to me is sentiment. There was times when everyone was maximum bullish, went maximum bearish, and now we're back to that excessive sort of optimism. So that's what I look for in when I'm trying to find long-term holdings, looking for stocks that are bombed out where sentiment's really pessimistic, and yet can see sort of a good growth profile over the medium term at least. So to me, really, that volatility really does offer more opportunity than risk. I think if I was a short-term investor, I'd be worried in that sort of environment. Trendless market is dangerous, but being a long-term investor, I think it's more of an opportunity.
And what about self, James? Anything to add?
Yeah, I think the market was pretty rudderless sometimes during the year, and I think that does. I think if you don't know your stocks and know your valuation parameters, it can be very disturbing. But if you do know your companies, and there is a valuation sentiment movement where the multiples are falling, but the earnings are not, it can be a great opportunity. Certainly in technology, that was a really good opportunity early on in the year. and then later in the year, technology has been quite strong as multiples started to expand. In the I guess across the board in terms of sectors, like industrials had good results and consumers had good results. And now we're getting to the point where you got to be careful actually not to run with the greed too much, because in technology, some of the stocks you've got are on 100 times PEs. Templar Webster's gone to 200 times PE. Autonate's on 100 times PE. Promedicus nearly on 100 times PE. And then the stocks that have really fallen and been weak during the year, they're on 10 to 12 times. And the market's on a 15 times average. So I think it's a good market for opportunities. You just need to be very careful. You don't get too caught up in this new bullishness that's really emerging in the market. Be very disciplined on valuations still.
If we sort of reflect on 2003 and probably sort of at the beginning of the year, there's an element of sort of pessimism. Inflation was above 7% here in Australia. People were worried about and continue to be worried, I guess, about cost of living, impact on households and so forth. What has been, I guess, the thing that has surprised you the most about 2023 in terms of the markets, or how certain stocks or sectors have performed in this environment?
To me, there's really three. When I look back on 2023, there's probably three things that stick out. One sector and a couple of individual companies. So the first part is, and I'm sure we'll all agree, like the consumer has really hung in there. So from a lot of negative press and a lot of pain that you see, it doesn't really have seemed to have impacted the consumer that significantly. And in fact, when you look at consumer discretionary stocks, actually did quite well, or reasonable, I guess is the best way to say it, reasonable in 2023. So Australia's growth, GDP growth has slowed. The consumers maybe slowed a little bit, but has actually hung in there much better than expected. And so that to me was a real standout. I guess my view would still be that, the higher interest rates have got to have an impact at some point. And there's an argument that maybe they hung in there a little bit better because there was a big savings boost through COVID, and really they've been running down their savings over 2023, which has kept them spending money. But, maybe as we go into 2024, that runs out or gets much lower. So that, to me, the consumer, that's one big one. The other really interesting one was, and this is very company specific, I think Qantas was very much one of the highlighted stocks, probably for the wrong reasons. I think they probably went down the track of there's a whole range of different issues they did, and then there's a whole range of corporate governance issues that maybe weren't quite what they did. But actually, you can show. I think that also demonstrates, if you're not on your game, you can actually lose your social license pretty quickly.
Yeah.
I mean, and Qantas, I would say generally, over the long term, is sort of a loved company. It's an Australian icon. People love it's obviously has been a great airline for a long period of time. But they probably just missed the mark over the last couple of years, and maybe didn't quite respond to conditions as they should have, and they paid the penalty. And now with the new chief executive, Vanessa's really got to address those issues, and they've got to earn their social license to operate again.
Yeah, absolutely.
The second one, and then the third one actually was healthcare was a negative performing sector. And really the big issue, which was very unusual, was the disruption of the GLP-1 drugs, in particular Ozempic. So that had a big impact, and it was very disruptive. So look, they're the big three. When I think about the year, they're the three that stand out to me: consumer, Qantas, and healthcare with Ozempic. Yeah.
Yeah. And what about yourselves, Casey and James? What were some of the key things that sort of surprised you this year? If we reflect?
Yeah, I think from a sort of top-down macro perspective, the fact that central banks around the world didn't run aground, didn't make any mistakes, I think that was a surprise, because I think central banks are set up to make mistakes, given their only tool is monetary policy, which operates on a lag to the economy, and they're setting monetary policy based on lagging data as well. So, I don't think it's much of a coincidence that they make a mistake in most cycles, but so far they've been able to navigate this cycle really, really quite well, at least year to date anyway. And, that sort of extends that there wasn't any major blow up in the system. Right? We did have some scares. You had the UK gilts crisis, which was last year, actually, September 22, and then the whole Credit Suisse and Silicon Valley Bank debacle in March. But it didn't spread, didn't become endemic through the economy. There was emergency liquidity and bailouts, and central banks sort of did pretty well there as well.
Casey, I think that's a great point because everyone's been waiting for something to break. That's really been the sort of thought process. And as you said earlier, I mean, Silicon Valley and Signature did, but really has been nothing since then, which is quite surprising.
Yeah, it's not to say there can't be more, and there is still some hotspots, I think, potentially in leveraged private equity and commercial property as well, where it's just been absence of transactions, and perhaps when they start transacting, it leads to a gap down in valuations as well. But there's some sectors, there's some areas of the economy they potentially can kick the can far enough down the road that by the time the market, the macro conditions are improving, they can get through that sort of thing as well. So I think that was a surprise to me, that how well the central banks around the world have managed the cycle. And to Paul, on your point on consumer, I think that was a surprise to me. But I think if you sort of delve down into the consumption as well, I think one of the biggest surprises, and it probably shouldn't be a surprise in hindsight, but is the dispersion in consumer spending by age cohorts. So basically, the younger you are, the less you're spending, because more cost of living is biting you with rent increases, and you're on lower salary, you're not at your peak earnings. Whereas if you're a retiree with cash in the bank, now earning an interest rate for the first time in a long time, they're spending up big, and you can even see that within segments, right? Within travel, the things like cruises are doing really well, whereas some other travel is starting to roll over.
Yeah, no, I think that's been the consumer one's been really interesting because I think everyone's expectation was that the consumer would roll over, but to your point, once you sort of really dig down further, it's not a uniform cohort, right?
No, definitely not. Yeah,
James, for yourself, what was sort of the key surprises?
Probably big four. So consumers, the first one that's been talked about already, but the dispersion. But people are still chasing sales. So Temple & Webster mentioned Black Friday sales were huge. So people are still buying sales, and also remember that inflation is a regressive tax. So the demographics at A's and B's are probably less affected, but C, D and E are more affected. But people are still chasing bargains. So I think consumer, but the resilience overall, I think, was one of the big one surprise. Number two, I'd say lithium turning off very sharply on the negative for the last 3-4 months has been very sharp. So it's cost inflation, labour shortages, but also then government stepping in and taking over assets. That was really strong, and resources overall was very strong first half. Second half has been pretty weak overall, and the analyst Sam's mentioned that the margins are coming off, pretty much for the last 6 months.
And I think, James, just on your point on resources and lithium in particular, that shows some of the big shifts in the market that we've seen throughout the year. Because if you look back at the start of the year, all the short positions in the market were in tech, higher for longer interest rates, going to affect valuations. They came out of those shorts and they went into resources, in particular lithium, which is the tech commodity, if you want to say. You've seen that rapid rotation in those sort of shorts as well.
It's come off pretty hard. And the big one, just the last 4 or 5 weeks, the sentiment shift has been phenomenal in small caps. But the thing is, it is multiple expansion mainly, but from AGM season, there is actually fundamental strength in a couple of sectors, and the breadth of it is what has been the biggest surprise. So industrials, financials, consumer, and technology, pretty much from, I guess, October and November have been very strong fundamentally. Right. So there has been actual small upgrades, but the market's view is that that's the beginning or the beginning, of the end. Right. In terms of the end of the negativity is kind of done, and the market's now looking more forward. So you're getting small earnings upgrades, but you're getting big share price reactions.
Right. And is that sort of coincide with this general sort of view that maybe inflation is sort of
definitely
soft landing.
Peak inflation, peak rates, peak fear. I guess is what you'd say. The triple peak has kind of already passed, and now you go into the more positive. So. And that is very constructive, especially in small caps and mid caps, where it has been, multiple compression has been the big thing.
Brilliant. Probably one of the areas would be interesting to sort of explore is, I guess, if you sort of reflect on where we are at the moment, what are some of the things that at the end of the year you will be focusing on, I guess, from an investment perspective? Are there any particular stocks that, compared to the beginning of the year, that when you reflect on now that you're more interested in, or just generally parts of the market?
Yeah, definitely. It has been a really interesting year. I think this compression dispersion is a really interesting one. I think in macro times, when macro is very dominant, you tend to get a sort of compression. So sentiment's impacted and you get a compression of valuation. So things, whether they're high quality, low quality, high growth, low growth, they tend to trade on very similar multiples, right? The market becomes very skeptical. In those times, the market becomes very skeptical, and it's a shoot first, ask questions later type approach. But very recently, as James has just highlighted, it's as some of those macro variables start to stabilize, and if you think about it from inflation it's still a bit too high, but it's stabilizing. We're in the process of stabilizing. Interest rates are the same. They've come up a bit, but there's questions of whether they come back down or whether they stay up. But we're in that process now. Even geopolitical, while there's still a lot of conflict, and there's some signs. If you just look at China, Australia, there's some signs of better becoming better trading partners, etc. So in that environment, people then start to go back to focus on dispersion. So what is the difference? So if there's a company that's got high growth and a company that's got low growth, they're on the same multiple. Obviously I want to go for the high growth, and high quality companies or low quality company, you can start to differentiate. So that I think is starting to happen right now, but I think it will be a big feature of 2024. It'll be individual. It won't be macro driven. It'll be bottom up, individual company driven through 2024. So we're obviously very focused on that.
Great. Anything to add, Casey?
Yeah, well, I think as growth is slowing, and whether or not we have the most anticipated recession in history, I think that that means the timing is right to become more cyclical. Market bottoms before the economy, and you can already see the market's re-rating, even though earnings are still declining, which is a natural sort of cycle at these sort of turning points in markets. So, I'm looking to add more cyclicality, get less defensive type stocks, and particularly, if this inflation regime is changing from high to low, getting out of more of the stocks that have been the winners out of inflation and into ones that have been the losers and now can rebound as well. And I think a lot of those inflation winners in defensive categories as well have re-rated quite a lot, and that could come under pressure if there's a new regime in town.
Yeah, certainly a lot of similarities for me too. So watching for those winners versus losers. Winners in small cases have been the insurance brokers have been huge. So Austbrokers and Steadfast, they're both insurance beneficiaries. And then you look at the other side of it, the ones that have been inflation losers. So Collins Food was like chicken inflation, food commodity inflation negative, and they came out with a better result because they repriced. And that stock was up nearly 20% in the last little while. So there's definitely winners and losers of inflation as that cycle turns. And then in terms of valuation, there was a big valuation compression, as Paul mentioned, but the dispersion has moved very, very quickly. So you got stocks on, 8 stocks that are, more than 50 times PEs. So that's what you got to be careful of. And then on the bottom of that, you can find stocks that are on 10 to 12 times that have been hit by inflation that are quite interesting. So there is a lot of, I think, looking around and fishing that you can do, because there is a lot of dispersion now in the marketplace. And definitely, as Casey mentioned, I've definitely gone more cyclical the last 3 to 6 months towards industrials, financials, consumer and tech. And if that holds, then you will likely just see continued expansion in multiples and earnings for that universe. And that will be a good place to be for the next 6 to 12 months.
So I'm sensing a bit of optimism, but maybe the last question for this podcast is, I guess, just a one-word answer. Are you feeling, if you compare yourself to the beginning of the year to where we are today, more bearish, the same, or more bullish if you compare to 12 months ago? Paul?
Look, I'd say I'm more bullish, but it's actually mainly to do with, I think, more risks have entered. The funny thing is, more risks have entered the market. That's actually, it's a funny thing to say, but because more risks have entered the market and more is getting valued, more risks are getting valued in the market, to me that always presents a better, and I'm talking the next 5 years. I think that you look at periods when there is a lot of risk in market, they're the times that often provide you with the best longer-term return, expected longer-term returns. Yeah. When it's all blue sky and just optimism, that's when the outlook is not that's when the outlook tends to be a little bit tougher. Mm-hmm. But when actually people are worried about a lot of different issues, and I think that's still very much the case, that often provides you with the best longer-term returns.
Mm-hmm. Casey?
Yeah, well, I think it's pretty clear the winds have changed. We've had the persistent headwinds for a long time, and now they've switched to tailwinds. But that's also reflected in optimism in the market. I think particularly in some sectors as well. So have to be slightly cautious on individual stocks and valuations that have run hard, I think. But I think the outlook is more rosy, and you can see the sun sort of coming up over the horizon.
Yeah, we've definitely gone from batten down the hatches to pull out the mainsail and crank it up really fast. So that's definitely the case. So more bullish is definitely my view. And the thing is, it comes from fundamentals. It comes from this improving cyclicality. And like I mentioned, the breadth, industrials, financials, consumer technology, you don't get an improvement in that kind of breadth, that things aren't actually getting better. But as Paul mentioned too, it's the fear. A lot of the fear has come out, and I think that's a big thing. So you need to be careful of valuations that we've all mentioned. Valuations are getting up, so you need to be careful. So I think more bullish, but I do think just valuation discipline is still important, because the market will go from fear to greed pretty quickly as the risks dissipate and as that peak inflation, peak fear, peak cost, peak debt cost kind of psychology moves away. But then you need to be careful you don't go too far down the irrational exuberance path.
So what I'm sensing is some sort of cautious optimism. I'll put it at that. So with that, thank you very much for taking the time and join me on the podcast today. For the listeners out there, if you do like the podcast, please hit subscribe on whichever platform you are using. Just to remind everyone, we have been running a competition with this podcast in terms of for the first listener to come back to us with the number of nautical references we made during the podcast will win a $100 voucher. And just to remind everyone, email your answers to podcastsaustralia@fil.com, and we'll keep an eye out for that.
Do we even know how many nautical references we made ourselves?
I think we've had our engineer here who's been running the podcast has been busily noting down how many references there are. So, so I think we're good. And if anyone would like any more information about Fidelity, please refer to the Fidelity Australia website, which is www.fidelity.com.au.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.